Do you have a 401k, an IRA, or a pension plan? The IRS wants you to think those qualified plans are the best way to save money for retirement. But are they? They entice you to contribute the maximum amount to your plans by giving you tax breaks right now and allowing your money to grow tax-free over the years. On the face of it, it sounds pretty logical, right? Wrong. Look a little deeper, and the fact of the matter is that putting money into a 401k or an IRA is almost the worst thing you could do for your retirement. Why? Because you're going to be taxed heavier than you expected when you finally retire and start receiving the income from those accounts. Then guess what happens to the money when you die, if there's any left? The IRS is going to hit your beneficiaries with a double whammy. First, they'll tax your estate, reducing what is left. Then, when it's inherited by your heirs, they'll tax it again as income to them. And after you've had to deal with all the market volatility that can reduce your portfolio in the blink of an eye, just think about 2001 and 2008. A bit worrisome, isn't it? What if there was a way to avoid tax burdens at retirement? A way to avoid depleting your portfolio during down years in the market and virtually eliminate any worries you may have about outliving your money during retirement. During this video, I want to show you an IRS-approved type of retirement savings plan that will knock the socks off of your IRA, 401k, or pension plan. These are not new plans. They've been around for years. They're offered by the oldest, largest, and most financially stable institutions in the world, and they allow your money to grow tax-free just like your current qualified plan, but without you having to pay income taxes when the money is withdrawn during retirement. And there's no taxes on your estate when you die and no taxes when the money is transferred to your heirs. Think about it. Zero taxes as your money grows, zero taxes when you start using your money, zero taxes on your estate when you die, and zero taxes on the money inherited by your family. No federal income tax, no state income tax, no estate income tax, and approved by the IRS. And it gets better. Unlike many qualified plans, there's no risk that you will lose principal in a down market. Should the market take a dive like it did in 2008, your worst-case scenario is your money remains level. No gain, but no loss. What I'm talking about is a strategy. We call it the tax savings plan that makes sure you don't outlive your money during retirement. Let's start with the IRS. We've already established they want you to think that IRA savings plan for retirement is your best bet. I'm talking about what the IRS calls qualified plans. What you know as tax-deferred plans, IRAs, 401ks, pension plans, etc. Compared to traditional brokerage accounts where you'd normally buy stocks, bonds, and mutual funds, these tax-deferred plans do have some really good tax advantages. You can invest in qualified plans with pre-tax dollars, and you don't have to pay taxes on gains in these accounts every year like you do with a regular stock or mutual fund account. Thus, your money grows tax-deferred. It's not taxed until you retire and start pulling the money out of the account. That means you have more money working for you during those years leading up to retirement. Sounds like a pretty good plan, right? Right. When compared to a regular brokerage account, sure. Understanding the difference between tax-deferred and tax-free is key to maximizing your retirement savings. Qualified plans are tax-deferred, and that's also how your money grows. Therefore, it will be taxed at some point in the future, probably when you retire. When you retire, tax rates are very likely to be higher than they are now, and you may not have any IRS deductions for kids or mortgage interest. That means you'll be paying a huge percentage to the IRS in taxes every time you take a withdrawal, thus reducing the amount you have to spend on your living expenses and your lifestyle. Uncle Sam is counting on you to pay more taxes when you retire. Pretty smart, isn't he? I'm all for paying my fair share of taxes, but I've got to tell you, I'm not interested in giving the IRS a bare minimum of $33,000 for every $100,000 I withdraw from my qualified plan when I retire. You've paid taxes and will continue to pay taxes your entire working career. Why allow Uncle Sam's hands into your wallet when you retire? And realize that $33,000 out of every $100,000 you withdraw isn't necessarily the worst-case scenario. There's a probability that tax rates will rise. If you're paying attention to the news, you know that a tax rate of 40 or 50% isn't out of the question. So let's talk about the TSP, or Tax Savings Plan. Here are the highlights. The tax-free strategy, like a qualified plan and way better than a brokerage account, allows your money to grow year after year without you having to pay taxes on the annual gains. It has compounded interest, allowing your money to grow larger and more rapidly. Then there's a tax-free distribution. Here's where qualified plans start to fade. Your money not only grows tax-free, but you can receive the money at retirement tax-free. That means that on the same $100,000 distribution that I just talked about, you keep it all. No federal income tax, no state income tax, no income tax for your retirement, regardless of the tax rate when you start drawing on this account. You won't care. You'll pay no income taxes. 40 to 50% tax rate, not your concern. Your retirement savings can be used tax-free. When you take $1 out, you get to spend the entire dollar, not 67 cents or less. Which do you prefer? Then there's your legacy tax-free transfer. With a deferred account or with a regular brokerage account, your money will likely be taxed twice when you pass away. First on the amount left in the account when you die, and then again when your heirs receive what's left as income. Probably not what you would prefer, but Uncle Sam gets the last laugh. The TSP account has no death taxes and no inheritance taxes. Whatever you have in your account when you die, your heirs get it all, 100%. Now, there are some exceptions and limitations, so discuss this with the team member who gave you this video. Next, there's no risk of loss to your principal. Remember when the stock market lost half of its value over an 18-month period beginning in the fall of 2007? Did you start having nightmares about being 90 years old and still working at a fast food restaurant just to put food on the table? Most qualified plans have no protection from that type of market volatility or downside losses. But the tax savings plan does. The principal in this account never goes down. When structured properly, there's no chance you will lose anything, not a penny. If you'd been on board with this in October 2007, your portfolio would probably look a whole lot prettier than it does right now. I'll explain why and how. Some think if you've saved $1 million for retirement and you retire at age 65, that's pretty good. It is if you expect to stay healthy and not live past age 75. So how do you stretch what you've saved for retirement out over a 15, 20, or 30-year period, especially with the uncertainty of increased taxes, increased cost of living, and the possibility of needing specialized care if you end up living to your 80s or into your 90s. When structured properly, it'll keep on paying and paying all through your 70s, 80s, and 90s, well, for the rest of your life. But before that, let me address the question that I know is nagging you. You find all of this intriguing, but you're thinking to yourself, what's the catch? We all know that anything that sounds too good to be true probably is. The catch is that this is not a get-rich-quick scheme. It's a retirement plan that's been around for years. But it has to be set up correctly, or it's not tax-free. Just because you may not have heard of this before doesn't mean it's not tried and true. It doesn't mean that hundreds of thousands of people aren't currently using it, and it doesn't mean that all the advantages I've talked about aren't sitting there just waiting for you. Per IRS rules, you have to fund this plan with after-tax dollars. You can't deduct the amount you contribute off your current year's taxes like you do with the deferred plans. That means that if you contribute $6,000 this year into the TSP, you'd pay an extra $2,000 in taxes this year, assuming that you're at a 33% tax bracket. To help understand why funding your retirement with after-tax dollars instead of before-tax dollars, like you would with deferred plans, is not a drawback, think of it this way. If you were to start a nursery business by buying $1,000 worth of plants that you could thereafter propagate by cuttings, would you rather pay taxes on the original plants or on all the plants grown from those initially purchased plants? Let's apply the same rationale to your retirement savings. The amount of money you save on upfront taxes with a deferred plan. Remember our previous example? You'd save $2,000 in taxes by making a $6,000 contribution into the qualified plan will almost certainly be less than the taxes you pay at retirement on your original investment and its growth. Here's why. If your $6,000 grows to $100,000 over the course of the next 30 years, and remember, with compounded interest, this is very reasonable, you'll pay at least $33,000 in taxes. That's $33,000 straight to the IRS right when you need it the most. And that's if taxes don't go up or tax brackets are not changed. Would you rather pay $2,000 in taxes right now or $33,000 or more in taxes later? I'll say it again. No wonder Uncle Sam loves deferred plans so much. It's the government's way of protecting the government's financial future.